NW 1120 AM, NW 275 CM FM, Concord, Boston. The Money Matters Radio Network.
For 40 years, Cancer Support Community has been a relentless ally for anyone impacted by cancer, with free services provided online and in person, with their newest location in Massachusetts. Connect with Cancer Support Community Massachusetts for free emotional support, educational resources, patient navigation, financial counseling, and more. 617-797-3391. CancerSupportMass.org. CancerSupportMass.org.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke with your Financial Exchange Quick Tip of the Day. And today, we're talking about the top estate planning mistakes to avoid. Todd, a lot of people create their estate plan, but there are some that don't actually transfer assets into it. Can you explain why this is such a big mistake?
Sure. I'm going to try to explain it both from a revocable and an irrevocable planning standpoint. With the revocable, if you don't put assets in there, you end up leaving them owned perhaps jointly if you're married, and designated beneficiaries and the like. But if everything goes to the spouse when one dies, then you've completely avoided your estate plan. In other words, you've set your trust up, but you went around it by leaving everything to the spouse instead of going through it by funding the trust and cramming down the assets to shelter some from estate taxes on the first death, so there's less taxed on the second death. And ultimately, on the second death, if you don't plan, there could be a probate problem because everything would go to probate if it's in their own name. The other big reason is with an irrevocable trust, of course, not funding it also can result in estate tax problems by the same way it did with the revocable trust. But in addition to not funding them with the irrevocable, you don't even begin the 5-year waiting period to get the assets protected from the nursing home. So there's a much bigger problem not funding an irrevocable trust versus not funding a revocable trust. So make sure you fund your trust if you do your planning.
Well, luckily, Todd Lutzke and the estate planning experts at Cushing & Dolan have written a brand new guide that details the estate planning blunders to avoid. You can request this brand new guide by simply calling 866-848-5699, 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Building a solid financial strategy is a core element to enjoying your retirement years. That's why you need advice that you can count on. At the Armstrong Advisory Group, we understand the challenges of positioning your assets to help you maintain your wealth over time. Our goal is to offer advice that is both suitable and in your best interest. When you hire one of us, you hire all of us so you can be comfortable knowing that every advisor in our firm is dedicated to helping you create a realistic plan for your later years. Visit us today at armstrongadvisory.com and sign up for a free, no-obligation planning session. Click the Get Started button at the top right corner of the homepage, and you can select the day and time that works best for you. Go to armstrongadvisory.com and let us help you secure your financial future. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Are you looking to volunteer for an amazing nonprofit organization that helps our veterans? The DAV Department of Massachusetts Transportation Network needs volunteers right now. This network provides free transportation to and from any VA medical appointment for veterans of all eras. To become a volunteer driver, you do not need to be a veteran or a DAV member. You just need to have the willingness to help our veterans and have a valid driver's license. Sign up now at davma.org. That's davma.org.
The U.S. Virgin Islands is the perfect destination for your next vacation. Visit St. Croix, St. Thomas, or St. John and experience incredible weather, iconic history, pristine beaches, world-class cuisine, and a vibrant nightlife. Book now and you might just make it in time for the St. Croix Mango Melee on July 7th. The family-friendly event offers food demonstrations and tastings, cultural dance performances, and the ever-popular mango eating contest. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, no passport required, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. The DAV 5K Boston is presented by Veterans Development Corporation. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Good morning and welcome back to the Financial Exchange. It's Mike Armstrong, Paul Lane, and Tucker Silva with you on a Tuesday, a Producer Price Index Tuesday, and the day before the all-important Consumer Price Index reading, which will be coming out tomorrow. We've got earnings out from Home Depot, some leadership changes at Amazon, and continued craziness in the meme stocks, which if you don't recall what I'm talking about, you have to go back a few years to recall the meme stocks, but AMC and Gamestop, some wild stuff going on with their stock prices. We'll be covering that as well. But first data point to cover, and one of the big ones coming out this week, is the Producer Price Index, released this morning at 8:30 a.m. Initially, markets down a bit on a hotter-than-expected report, with producer prices increasing 0.5% month over month. Well above anticipated numbers, but after, an hour and a half to settle in with this data, markets are basically flat, with the Dow up 0.1%, S&P and NASDAQ both up 0.1%. Paul, any key takeaways that you had on the data here, which admittedly can be quite volatile compared to other inflation measures?
Yeah, just to summarize, the Producer Price Index is the average change of prices that producers are receiving domestically when they buy goods and services. CPI, Consumer Price Index, is what we, the end consumer, are paying for them. So just to make that distinction there before we dive into the data. In terms of what we saw, Mike, I think you can initially interpret this report as hotter than anticipated and pointing to perhaps stickier inflation, which we talked about a lot. But however, once you couple that with the revision that we saw in March's data, where initially it was reported as a 0.2% month over month increase in the month of March, that was revised downwardly to negative 0.1%. That combined with this 0.5% increase that we saw for April's data that we're about to dive into leads me to be a little less concerned on the data and a little bit more neutral in terms of what this means. In terms of picking out something that I just found a little bit noteworthy, the services area that we're still seeing increases on that side of things. So the service component of PPI in terms of what people are paying for services, when that's leisure and hospitality, concerts, all these other types of different events, it seems like that still remains quite resilient. And that's something that we've sort of heard over and over again, and you're continuing to see it play out in the data here. No doubt. And to speak to that volatility a little bit, I'm just going to read to you the last 6 months of data. April, up 0.5. March, down 0.1. February, up 0.6. January, up 0.3. December, down 0.1. November, up 0.1. This is a very volatile data series. What you're looking for here is, are you seeing prolonged pressure on prices on the producer side that will eventually lead to inflation on the consumer side, right? That's what we ultimately care about. That's what the Federal Reserve cares about. And frankly, that's what households care about, right? It's like, yeah, sorry, Amazon, that you're facing some higher wage costs and it's more or less expensive for you to fly your executives around. But that's not terribly important for me, the American household. What I care about is, are you increasing prices on things that I pay for? And I don't know that the last 6 months of data here from the Producer Price Index would indicate that we are in for a prolonged period of inflation based on increased producer prices. What also seems to be happening here is, there's
two reports coming out this week, both from the Bureau of Labor Statistics. There's the producer prices that I mentioned. Tomorrow you get the consumer prices. If you take pieces from each of those reports, you can put it all together to try and figure out what the preferred measure for the Federal Reserve is telling you in terms of inflation, which is the personal consumption expenditures index, put out by a completely different bureau, the Bureau of Economic Analysis. This is a little bit technical, but if you dive into a few of the items that actually come from PPI and are counted in that preferred inflation measure, those actually did not show too much inflation. So among those items, the cost for hospital outpatient care ended up falling 0.1%. Airfares dropping 3.8%, which I do find surprising given that there's a lack of aircraft out there for these companies to purchase, and some of them are cutting routes, but nonetheless, airfares dropping 3.8%. Portfolio management services increased 3.9%. I'm kind of surprised that goes into PCE, but nonetheless, you had a bit of a mixed bag, and certainly a smaller increase on a few of those items that actually do make their way into that PCE index, which is the Fed's preferred gauge on inflation.
Yeah, certainly. I think you hit on some good points there. It'll be interesting to see what the exact print is on the PCE side of things, and really CPI will be at the forefront of our minds tomorrow when that data really comes out.
And we'll certainly, I think, have the ability to shake markets a little bit more in one direction or another.
Yes.
And one thing we know is certainly true, which is gas prices in April were up. They retail gas prices in April got to their highest level since October. So, yeah, we tend to strip out food and gas prices, but that initial headline I expect to be higher for gas prices alone, and that will certainly feed into things. Anything else on producer prices here before we move on, Paul? Because I think, like I said, it doesn't seem to be shaking markets a whole lot. And while that was initially surprising, because this was a pretty significant increase compared to where markets had things anticipated, honestly, when you dive into the details here, not a whole lot of story, because honestly, you can't really take 1 month of this data and tell yourself anything about where household prices are going to go, either through the CPI or PCE inflation measures.
No, the services component I hit on, and you made the key points regarding how it translates to PCE. So other than that, I think it's a data point that you log, but otherwise you really focus on what we'll see from CPI tomorrow when that report comes out.
Speaking of which, so 8:30 a.m., the Consumer Price Index will be out tomorrow. In terms of the median forecast for year-over-year numbers, we're looking at a 3.4% increase for that median forecast. Month-over-month is 0.4%. When you strip out food and energy, a 0.3% increase. And taking a look here, the last 3 months of month-over-month inflation data from CPI coming in at 0.4, 0.4, and 0.3. So I think the main question there, and when you strip out food and energy, by the way, it's actually worse. So if you strip out food and energy, it's 0.4% for the last 3 months. And so main takeaway that I have would be, are we continuing this trend? In which case, the status quo doesn't really change all that much. It just confirms that rates are unlikely to get cut, even though there's been a couple weeks of trading data now that have been insinuating perhaps some rate cuts, and perhaps that the inflation data is going to come in better than anticipated. If it comes in lower, again, markets will rally. I have no doubt about that. But you don't really have a change in the narrative, because if you are Jerome Powell at the Federal Reserve, you're not going to take 1 month of good data and say, oh, yeah, we're cutting at that next meeting. When do we have the next meeting coming up for the Federal Reserve, Paul?
June 12th.
So by June 12th, we will have an additional month's data on the inflation for May. And so the question would be, okay, do you get a good report tomorrow followed by a good report in mid-June that gives the Fed enough leeway to say, yeah, we're going to cut by 0.25% here? Or do we get a report that's pretty much a repeat of the last several months here tomorrow, and just allows the Fed to, or requires the Fed to kind of stick to their guns on rates higher for longer?
To me, what it's going to come down to, or what I'm most interested to see from the report tomorrow, is what the shelter costs are going to look like on the CPI report, where that has been so convoluted and hard to wrap your arms around, that I'm interested to see if there will be any relief provided by shelter costs. It's been long talked about for about a year.
I'll tell you, Paul,
so.
It seems to me like you've been saying that for the last 9 months
I
of
know,
inflation reports. I'll be really interested to see tomorrow if housing costs finally fall off.
Are they
At some point, we got to stop wondering if they're going to.
So you just think it's done?
I don't know. I mean, everybody's been talking about this, not about 9 months. They've been talking about housing prices coming down in CPI for 18 months.
Yeah.
And it hasn't happened. At some point, you just have to sit here and say, okay, well, until it shows up, we're not going to bank on it showing up in the future and assume that it will at some point, but you can't rely on it forever.
I guess otherwise, what would you point to into tomorrow's report being a positive sort of disinflation report? What are the catalysts? We've talked about that a lot. Other than that, and that's probably why I keep throwing it out there, because it's going to be the saving grace that comes in and gets us a better overall report. I can't point to anything else. You mentioned energy costs, which we get are volatile, and there's a reason that the Fed strips them out in their analysis, but headline matters for all the psychological components of it. That's not going to give you any break for the month of April, so it's just hard to point to what the items are going to be that provide significant relief in tomorrow's report.
Right there with you. Let's take a quick break. When we come back, let's talk a little bit more about Fed and where people think rates are going. They seem to be falling into one of two camps here. We'll discuss that next and what that means for American households right after this.
Breaking business and financial news first throughout the day. Only here on the Financial Exchange Radio Network. Proper estate planning is crucial to you being able to enjoy your later years, and it may be the difference between retiring comfortably or living under incredible financial pressure. Creating an estate plan can be a difficult process if you aren't working with an expert who will make sure that your plan is secure. Cushing & Dolan can help. Call them today at 866-848-5699. Estate planning is their business, and they have a new guide out this month called Detour Ahead, Estate Planning Blunders to Avoid. Don't put your assets at risk and open yourself up to severe tax consequences. Even if you already have a plan, this guide may help you correct an issue that could come back to bite you in the years to come. Call right now, 866-848-5699, and get your free guide today. That's 866-848-5699. Or request it online from their website, LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. The U.S. Virgin Islands is the perfect destination for your next vacation. Visit St. Croix, St. Thomas, or St. John and experience incredible weather, iconic history, pristine beaches, world-class cuisine, and a vibrant nightlife. Book now and you might just make it in time for the St. Croix Mango Melee on July 7th. The family-friendly event offers food demonstrations and tastings, cultural dance performances, and the ever-popular mango eating contest. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, no passport required, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
If you want to leave behind a financial legacy for your family, you need a proper estate plan. Hi, this is Chuck Zada from the Armstrong Advisory Group. In our new monthly guide, we'll explore how and why the estate planning process is crucial to help you build a plan that will afford you comfort and peace of mind as you enter your retirement years. The guide is called Leaving a Financial Legacy, and in it, we'll unpack ways to create a plan that takes into account your entire investment portfolio and your business holdings, including real estate. We'll also explore strategies on how to mitigate your risk from long-term care costs, which could affect you in the future. Call right now at 800-393-4001 to request a copy of our new guide, Leaving a Financial Legacy. That's 800-393-4001, or request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange streams live on YouTube. Like our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
The Financial Exchange has built an incredible partnership with the Disabled American Veterans Department of Massachusetts. We can't wait to take part in this year's DAV 5K, set for Saturday, November 9th at Fort Independence on Castle Island, and registration's now open. You can help our great American heroes by walking, running, or simply making a donation. Your gifts will support services such as the Veteran Advancement Program, which offers permanent and affordable housing opportunities for veterans and their dependents. Learn more at dav5k.boston. The DAV 5K Boston is presented by Veterans Development Corporation.
So, forecasters seem to be falling into one of two camps when it comes to interest rates, and I guess I'll give my own camp, but honestly, I don't have a high degree of conviction as to where inflation and interest rates are going to need to go. I tend to think that the Federal Reserve should just kind of be quiet about it and see what happens and wait for it to happen. But the two camps are mainly that, hey, this is a bump in the road and inflation is coming under control. It's just going to take a little while longer. The second camp is that the labor market's still too hot, and that's going to prevent inflation from coming under control in any meaningful way in the near future. And I tend to fall into camp 2, not all that firm in terms of my conviction, but I tend to think that, hey, so long as the labor market remains as tight as it is, which we will see, maybe it weakens, but so long as it remains as tight as it is, the Fed will have a difficult time bringing inflation down to their stated goal. And that's, I think, one of the underlying problems with the Fed strategy is this big stated goal of 2% inflation, which they can't walk away from now, but that is their goal, and their ability to hit it when the labor market is this tight, I somewhat doubt.
I always push back. I feel like they have that 2% stated goal, but most people would probably say it's within reason. You're trying to get within that range. Not necessarily it has to be hit at 2 exactly, right? It's just more of something of a guideline. I would fall in that second camp as well, Mike, this idea that inflation, if you just look back historically, which is not always a perfect way to do things, but it's the only way that you can really study what has happened in the past. You typically, in order to get inflation to come down, you have had to have some pain in the labor market. We have not had that yet. And where the Fed sits today, they've always been quite focused on appeasing markets and the investor community, and they've been trying to navigate this soft landing approach for the longest period of time. And some could argue perhaps to their detriment in terms of how quickly they started raising rates. And then you could also argue again towards the end of December, where they sort of announced this pivot party that the New York Times references in their piece, that again, it was another situation where they came out in a very accommodating tone that they didn't necessarily need to strike. No one was really asking for it. So where I land really is that we haven't seen enough pain in the labor market in order to make the compelling argument that we are going to see significant improvement to hitting the Fed's overall target of that 2% number.
So I bring up that target because I think it's worth mentioning, and in my view, the Fed has kind of painted themselves into a corner here with it by saying, no, 3% is not good enough, 3.5% is not good enough, we're getting down to the 2. We will see if they stick to their guns on that, but so far they have. And what I would just say is that there have been other periods of time where inflation didn't hit 2%. And I don't think anyone would describe them as a bad period of time. So taking a look at, this is data from Investopedia. I don't know where they're citing the inflation data from, but probably CPI or some other reading that they formulate CPI from. In 1990, you had 6.1% year-over-year inflation. Then 3.1% the next year, 2.9, 2.7, 2.7, 2.5, 3.3, 1.7, 1.6, and 2.7. You had a decade there where only in 2 years did inflation actually get to the Federal Reserve's stated goal. I just wonder out there, does anybody take a look at the 1990s and say, wow, what a bad period of time for the United States economy? Inflation was way too hot. No. Everybody talks about the 1990s as a period of time where the labor market was one of the best they had ever seen. It was a reasonable time to buy a home and see it appreciate. Deficits weren't all that bad. In fact, they were getting under control back in the 1990s. It was generally looked at as this period of, frankly, a fairly exceptional economy. Can you make the argument that it led to the dot-com bubble and a bunch of problems later down? Absolutely. So don't get me wrong. But if your goal is saying, hey, we have to get down to 2%, but you have this economy where unemployment's sitting sub 4%, economic growth is pretty good, in my view, you might just be willing to say, hey, yeah, if we get to 3.2%, that might be good enough, and we're not going to punish this economy too badly if we get there. So we'll see what the Fed actually does if we sustainably get to 3% inflation or 3.2 or 3.5. We're not really there yet.
Right.
But that would be the argument that I would make is, hey, maybe we should be a little bit flexible on this 2% goal. But this Fed can't do that because they've painted themselves into this corner, and I think they would lose all credibility by doing so. You mentioned something that I think is also really important with this Fed that I would also be critical of them, which is, in my personal opinion, they seem to be overly sensitive to what is happening in equity markets.
Yes.
So paying way too much attention to the capital cost. And the reality of the Fed's tools is that they tend to hit people with debt or that need new debt the hardest, right? So if you have a credit card or need a new auto purchase or haven't bought a home yet, then you're in a far worse position than if you don't have credit card debt, you don't have a home equity line of credit, and all of your debt is fixed interest rates. If you're in that camp, you also probably own a bunch of capital assets like stocks or businesses or something else where you've seen appreciation from the Fed's policy over the last few years. And that would be my biggest critique, right? Because quite honestly, if you just allowed equity markets to be a little bit more fearful of your policy and just you addressed the nation and said, no, look, rates are going to stay higher for longer and it's going to hurt and we expect some pain, then you might see an equity market sell-off of 20%. And that might actually fix the inflation problems that we're seeing right now, honestly. I'm not cheering for markets to fall apart here, but their actions of seemingly placating investors at every corner, in my view, is probably causing some of this more stubborn inflation that we still see right now.
I agree. I think that typically what you're supposed to see is, and we saw it in 22, interest rates rise, value of assets go down. When they pivoted in December, that led to a substantial rally where 8 or 9% the market rallied just in the month of December. The momentum has sustained over the first quarter, and it's really not the Fed's job to worry about that.
Let's take a quick break. When we come back, Wall Street Watch coming right up.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network. Proper estate planning is crucial to you being able to enjoy your later years. And it may be the difference between retiring comfortably or living under incredible financial pressure. Creating an estate plan can be a difficult process if you aren't working with an expert who will make sure that your plan is secure. Cushing & Dolan can help. Call them today at 866-848-5699. Estate planning is their business, and they have a new guide out this month called Detour Ahead, Estate Planning Blunders to Avoid. Don't put your assets at risk and open yourself up to severe tax consequences. Even if you already have a plan, this guide may help you correct an issue that could come back to bite you in the years to come. Call right now, 866-848-5699, and get your free guide today. That's 866-848-5699. Or request it online from their website, LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
We are the Debt Destroyer Network. Any debt you have, credit card, tax, student loan debt, call now for free information that helps you destroy your debt. It's great advice. Plus, when you make this free call now, we have Debt Destroyer experts ready to help. They can show you how to destroy your debt and get your life back on track. Debt problems don't have to be overwhelming. You can live stress-free and debt-free. Credit cards, medical bills, IRS tax problems, even student loan debt. Learn about free programs offered by the credit card companies, hospitals, and even the government that can help slash your debt. Call the Debt Destroyer now for free information. Call now. 800-430-8804. 800-430-8804. 800-430-8804. Again, that's 800-430-8804.
The U.S. Virgin Islands is the perfect destination for your next vacation. Visit St. Croix, St. Thomas, or St. John and experience incredible weather, iconic history, pristine beaches, world-class cuisine, and a vibrant nightlife. Book now and you might just make it in time for the St. Croix Mango Melee on July 7th. The family-friendly event offers food demonstrations and tastings, cultural dance performances, and the ever-popular mango eating contest. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, no passport required, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
A recent report from LawDepot.com says that only 3 out of every 10 adults in the U.S. have taken the time to create an estate plan. Don't be a member of that group. Hi, this is Mike Armstrong from the Armstrong Advisory Group. A sound estate plan can give you control over your assets and peace of mind as you enter your retirement years. Our new guide is called Leaving a Financial Legacy, and in it, we look at estate planning from a financial perspective. It's important to have a strategy that addresses your investment portfolio and all of your holdings, including real estate. We'll also focus on other issues, such as how to manage long-term care expenses that may affect you down the road. Get your guide today by calling 800-393-4001. That number again is 800-393-4001, or you can also request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Are you looking to volunteer for an amazing nonprofit organization that helps our veterans? The DAV Department of Massachusetts Transportation Network needs volunteers right now. This network provides free transportation to and from any VA medical appointment for veterans of all eras. To become a volunteer driver, you do not need to be a veteran or a DAV member. You just need to have the willingness to help our veterans and have a valid driver's license. Sign up now at davma.org. That's davma.org.
There are crucial mistakes you can make during the estate planning process that may have a damaging effect on your financial strategy. Cushing & Dolan's new guide is called Detour Ahead, Estate Planning Blunders to Avoid. Get yours today and make the right decisions to protect your assets. Call 866-848-5699. That's 866-848-5699, or request it online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch, a complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, markets are in positive territory as investors digest this morning's producer price index for the latest on inflation, where producer prices climbed 0.5% last month, above forecasts of a 0.3% increase. Tomorrow we'll see more on the inflation front when the consumer price index is published. Right now, however, the Dow is up by 60 points. S&P 500 is up by about 0.25% or 11 points, and the tech-heavy NASDAQ is up by about 0.5%. Russell 2000 is up another 1% today. 10-year Treasury yield down by 1 basis point, now at 4.46%, and crude oil is down nearly 1%, trading at $78.44 a barrel. The meme stock frenzy continues today, one day after famed retail investor Keith Gill, or Roaring Kitty, posted to social media for the first time in 3 years. Gamestop up by 75%, the last I checked at least, and AMC's stock is up by 96%. Meanwhile, Home Depot reported mixed first quarter results ahead of the open this morning, beating earnings estimates but missing on revenue. The home improvement retailer said it saw customers defer major home projects as a result of high interest rates. Paul and Mike will have more on that coming up here shortly. Home Depot down by about 0.5%. Elsewhere, the Wall Street Journal is reporting that Walmart is cutting hundreds of corporate jobs and asking most remote workers to move to offices. In addition, workers in small offices in Dallas, Atlanta, and Toronto are being asked to move to other central hubs like Walmart's corporate headquarters in Arkansas, as well as Hoboken, New Jersey, or Northern California. Walmart down by about 0.75%. Alibaba down by 7.5% after the Chinese e-commerce giant's net profit sunk in its fiscal fourth quarter, about 86% year-on-year. Alibaba did, however, beat revenue expectations. And Amazon announced that Adam Saplisky, CEO of Amazon's cloud computing business, will step down from his role next month. Amazon down by about 1%. I'm Tucker Silva, and that's Wall Street Watch.
So, Tucker, you mentioned Home Depot stock reporting earnings. They did before the bell this morning. Earnings per share came in at $3.63 versus $3.60 expected. So right on the money in terms of actual earnings per share. Where they missed was that revenue metric, coming in at $36.42 billion for the quarter versus $36.66 billion anticipated. A few things they had to say about the state of things right now. They continue to try and deepen their relationship with builders and contractors of different sorts. They had an acquisition to that end this year. But an interesting quote, I think, about individual consumers. Quote, "The home improvement customer is extremely healthy from a financial perspective." And he goes on to say, "And so it's not the case of not having the ability to spend." Let's just clear that up. So not double not, but the consumer, he believes, does have the money to spend. What they tell us is they're just simply deferring these projects as given higher rates. It just doesn't seem the right moment to execute. Mm-hmm. So I do find that interesting. Home Depot probably has a fairly good sense of what's going on with American homeowners and their actions right now. And given the lack of movement in the sale market, inventory for single-family homes and movement in that space, I actually would have anticipated continued demand from consumers saying, okay, well, if I'm not buying that new home that I wanted, I'm going to put on the addition, I'm going to renovate my existing home. Instead, the reaction, if we buy into what Home Depot is saying, and we'll see what Lowe's reports, which I think is next week or maybe this week, if they confirm the same type of thing, would be, I don't want to improve my home because I don't want to be here. And I'm not buying a new home because mortgage rates stink. So I'm just kind of sitting here and waiting this out.
Right.
Which I find intriguing.
I tend to sort of put some stock into that. And again, all of this stuff is anecdotal, the experiences that I had. But had a builder come by the house. We have a screened-in porch off set to the side of it. We're exploring the idea of converting it to a playroom, making it 4 seasons. And basically, I was asking him, how has business been? And the feedback that he had was eerily similar to what is mentioned by Home Depot here, is that really busy, but a lot of people are focusing on projects of sort of this size and scale. It isn't, let's totally put on a second floor to the home and do hundreds of thousands of dollars renovation on it, but let's do something that's kind of more moderate in size. And the same thing has applied for Home Depot for several quarters now. I feel like they have mentioned this, and it largely could point to this idea that previously when we were in 2020 or 2021, two things were happening. One, you were trapped in your house, so looking to make improvements to it, and the comps that Home Depot's faced against 21 and 20, it's almost just hard to replicate the sales growth that they saw in those years. So that's something that always holds them back a little bit. And secondly, the home equity line of credit option for people where interest rates sat on that at 3, 4, 5%, maybe in my shoes when exploring a project like that, I'd say, hey, you know what, 3%, 4%.
Capital's cheap.
I can handle that. Why not do it? Now, more cautious with my approach of, hey, let's try to look at this just paying cash down because I don't want to borrow at these high rates. And I think that's what we're seeing here on Home Depot's side of things with the larger scale projects.
I would think, however, that just like people can only delay the sale of a home and move into a larger home for a certain period of time, the same goes for these renovations. If Home Depot is correct that they are intentionally delaying these because they're nervous about the state of the economy or the cost of capital, or they don't want to be in the house long term, that tells you a couple things, which would be if activity does pick up, if interest rates come down, there may be some pent-up demand for all sorts of housing activity. We've talked about that in the sale market. It may also exist in the improvement market, and time will tell here. I don't think we're getting back to, what I was trying to remember how we priced lumber. Is it per yard foot or something like that? I don't remember the measurement, but we're not back at $1,000 prices here. But do you see some uptick in commodity prices if rates come down because of consumer demand for housing of all sorts, right? Whether it's purchasing new properties or renovating existing ones, that's of interest to me.
It's per 1,000 board feet.
1,000 board feet. Got it. Okay.
You sure it's not gallons? No.
Gallons of wood.
No?
Yeah.
Oh, okay.
Yeah, that'd be an interesting way to measure it. President Biden levying new tariffs on China and intensifying this trade fight, leading right up to the election here. And I want to talk about not so much the politics of the situation, because quite honestly, the politics of it are kind of boring. Two of the main candidates running for president want higher tariffs on China. Going deeper there is not terribly relevant because it's just minutia. The fact of the matter is that this is immensely popular right now. And so let's go through item by item here. The new tariff on Chinese electric vehicles has been moved from in the 20% range to 100%. So remember that project I was talking about, guys, where we would buy a Chinese EV and import it to the United States?
It just blew out the Armstrong.
It's off.
Yeah.
It's no longer going to be an affordable podcast or radio program. In addition, you have new tariffs going into place on a number, or existing tariffs that are getting raised on a number of different products. Steel and aluminum is going to 25% from 7.5%. Solar cells going up to 50% from 25%. Shipping cranes up to 25%. I have no idea what that one is about, other than I know that shipping cranes from China make up the majority of product across the nation here at many of our ports. And there was a story that either Wall Street Journal or Bloomberg did last year about how China had been installing modems on these cranes for an unknown reason, presumably to be able to take control of them. Tariff increasing to 25% from 7.5% for larger storage batteries, and a new tariff on natural graphite, which maybe somebody can educate me on what you use natural graphite for, but I genuinely don't know. New ones as well on electric vehicle batteries, critical minerals, and medical products, among other goods that are to be targeted. And then semiconductors, which I don't know which Chinese semiconductors we actually import, but that's going from 25 to 50. First of all, the one on cars, making headlines, meaningless. We don't import any Chinese cars in this country. So whether it's 25% or 100%, there's no tariff being collected.
Yeah.
75% more of zero is still zero. These other ones, I guess really it comes down to what you believe we are utilizing these tariffs for. Because I really have a tough time justifying how on earth a 50% tariff on solar cells or shipping cranes is of national security concern. But maybe that's not the intent, and clearly that wasn't mentioned here. It had everything to do with unfair trade policies from China, as interpreted by the Biden administration.
I agree with you, and by no means am I an expert on the solar space, but from my knowledge, it is pretty much impossible to do a U.S.-centric solar panel sourcing. You need to utilize resources from overseas, China and other countries, and perhaps there are alternatives to China itself, but to raise that tariff while you're trying to embed more renewable energy technology throughout the country, to me, seems sort of counterproductive.
It's completely counterproductive, Paul. I'm right there with you, which is, I understand there are competing priorities here, but if the Biden administration were genuinely serious about renewables and climate change, then you would be hauling in Chinese-made solar panels, EV batteries, and windmills by the truckload, by the boatload.
Right.
You would be buying this on the discount to whatever extent possible. The reality is that I guess would be unpopular with domestic manufacturers, no doubt, and they deem this to be unacceptable to, quite honestly, probably a very small number of Americans that work in solar panel manufacturing. But that is the bet that they are making is, hey, it's more important for us to protect that industry and develop it here domestically than to actually address what they seem to believe is a genuine problem with U.S. power generation, where it's not terribly sustainable and not based on renewable sources.
I researched trying to find a U.S. manufacturers solar panels. You're hard pressed to find it. It's really difficult.
And perfectly legitimate to point out that the only reason that's the case is because China subsidizes solar.
Right.
That is true.
Yeah.
It's a question of what do we want to prioritize. And at the moment, we seem to want to prioritize more and more items being manufactured domestically, which, okay, but recognize the trade-off. It's going to be much more expensive.
We want to prioritize a political agenda heading into November.
Certainly
that's what it is.
Certainly that too. Let's take a quick break. When we come back, I want to talk a little bit about Janet Yellen and some new commentary on the newest too-big-to-fail firms that are out there. We'll be right back with that next.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Like us on YouTube and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network. The U.S. Virgin Islands is the perfect destination for your next vacation. Visit St. Croix, St. Thomas, or St. John and experience incredible weather, iconic history, pristine beaches, world-class cuisine, and a vibrant nightlife. Book now and you might just make it in time for the St. Croix Mango Melee on July 7th. The family-friendly event offers food demonstrations and tastings, cultural dance performances, and the ever-popular mango eating contest. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, no passport required, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. Proper estate planning is crucial to you being able to enjoy your later years, and it may be the difference between retiring comfortably or living under incredible financial pressure. Creating an estate plan can be a difficult process if you aren't working with an expert who will make sure that your plan is secure. Cushing & Dolan can help. Call them today at 866-848-5699. Estate planning is their business, and they have a new guide out this month called Detour Ahead, Estate Planning Blunders to Avoid. Don't put your assets at risk and open yourself up to severe tax consequences. Even if you already have a plan, this guide may help you correct an issue that could come back to bite you in the years to come. Call right now, 866-848-5699, and get your free guide today. That's 866-848-5699. Or request it online from their website, LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
A recent report from LawDepot.com says that only 3 out of every 10 adults in the U.S. have taken the time to create an estate plan. Don't be a member of that group. Hi, this is Mike Armstrong from the Armstrong Advisory Group. A sound estate plan can give you control over your assets and peace of mind as you enter your retirement years. Our new guide guide is called Leaving a Financial Legacy, and in it, we look at estate planning from a financial perspective. It's important to have a strategy that addresses your investment portfolio and all of your holdings, including real estate. We'll also focus on other issues, such as how to manage long-term care expenses that may affect you down the road. Get your guide today by calling 800-393-4001. That number again is 800-393-4001, or you can also request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Are you looking to volunteer for an amazing nonprofit organization that helps our veterans? The DAV Department of Massachusetts Transportation Network needs volunteers right now. This network provides free transportation to and from any VA medical appointment for veterans of all eras. To become a volunteer driver, you do not need to be a veteran or a DAV member. You just need to have the willingness to help our veterans and have a valid driver's license. Sign up now at davma.org. That's davma.org.
There are crucial mistakes you can make during the estate planning process that may have a damaging effect on your financial strategy. Cushing & Dolan's new guide is called Detour Ahead, Estate Planning Blunders to Avoid. Get yours today and make the right decisions to protect your assets. Call 866-848-5699. That's 866-848-5699, or request it online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. The Financial Exchange is now available on your Alexa smart speaker. Ask to play the Financial Exchange and catch up on anything you might have missed. This is the Financial Exchange Radio Network.
Paul, what is the 4% retirement withdrawal rule?
Mike, the 4% withdrawal retirement rule was made back by 1994 by William Bengen as a sweet spot for retirees to take from their portfolios. So for an example, if someone had $1 million in total savings, they would be able to take 4%, so $40,000 a year in their first year of retirement and all the way through the end of their life, and not have to worry about depleting the $1 million that they had in savings. Now there is some questions as to whether or not that rule should still be used as a guideline.
So this is a piece from CNBC, and I don't have a problem with challenging the premise of the 4% rule. I think it should be looked at and revamped and thought about on a regular basis, and probably not used for, a vast majority of people when they actually get into the details of retirement planning. But this 6-page article goes through and talks about problems with it and doesn't really get to the point of whether 4% is too high or too low.
Which is
it just says that, hey, changes have happened and we don't have as much pension income, and so you should look at annuities maybe, or maybe you shouldn't look at annuities, or maybe the 4% rule should be higher, maybe it should be lower, maybe you shouldn't look at it at all. What if your health care sucks? And if you're going to write a piece about this, at least tell me what you think. Hey, is 4% unacceptably high? Is it unacceptably low? Does it not factor in a whole bunch of different things? I actually think that it's a reasonable starting point. But as we've talked about before, right, if you use all rules of thumb to generate your own retirement plan and don't look at your own specific situation, then you run the risk of being in some serious trouble. There are situations where starting at higher than 4% can make sense. There are situations where you need to start at way below 2% in order for your financial scenario to make sense. It depends on a litany of different factors based on your specific scenario. Like, do you have Social Security? How much will it be? What sort of lifestyle do you want to have in retirement? How long are you going to live? Do you have a pension? Do you have an annuity? Do you want to have one of those things? How important is a guaranteed income stream for you and your personal mental well-being with all of this? Here's my key point. Whether the 4% rule is still workable or not, I tend to think that it's, again, a reasonable guideline, but whether or not it still works is highly dependent on your personal situation, and I think leaves a lot of room for misinterpretation. If you have questions about your own personal situation, whether or not the 4% rule may be a reasonable target for you. Give the folks at Armstrong Advisory Group a call. We've got offices throughout New England, advisors that service those offices, and sit down with people free of charge to have a free consultation on their personal financial situation. You can call our offices at 800-393-4001 to book your own free consultation. Again, that phone number for the Armstrong Advisory Group, 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Treasury Department, led by Janet Yellen, is identifying a few non-traditional firms that they consider to be in that perhaps too big to fail camp. What are they referring to here, Paul? Because traditionally we think of the large 5 or 6 banks in the country as being these strategically important, too big to fail institutions. And because of that, they have some really strict regulation around them in terms of how they can operate and what sort of audits they are required to do. What would it mean for these other firms to be identified?
What it would mean is come down to the regulations that they're dealing with. As you mentioned, the business around mortgages has gotten so difficult over the course of the last 15 years or so that many big banks have stepped away. But now, if they were to be grouped in this area, that they could be forced to really change up their regulations in terms of what it would look like to adhere to some of the guidelines that Yellen is laying out here.
So according to the FSOC, non-banks actually originate 2/3 of mortgages and service 54% of balances. That's up from 39% and 4% respectively back in 2008. So these non-banks have taken a much bigger role. And the point that the Treasury is making is not that, hey, we want to backstop every major financial institution out there, but practically speaking, if one of these non-banks goes belly up, which is entirely possible, right? Mm-hmm. You've made a whole bunch of loans at 3%. New borrowing costs are at 8%. If you are not well capitalized, you could go belly up. What would happen to borrowers? What would happen to Fannie Mae? What would happen to the entire framework that sits on these? Like, if the non-bank that services my loan just suddenly disappears, do I still have a guaranteed mortgage? A whole bunch of questions get raised that are very important for this economy. Quick break, but a lot more to cover in the second hour. We will be right back, folks.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke with your Financial Exchange Quick Tip of the Day. And today we're talking about the top estate planning mistakes to avoid. Todd, what is the downside of adding your kids to your accounts or adding their names to your real estate deeds as a joint owner? Won't this avoid probate?
You're absolutely right. It would avoid probate, but there are better ways to avoid probate than just doing something simple, right? Simple isn't always better. Throwing a name on an account or adding a designated beneficiary or a joint owner on a piece of property might not be the best way to go. Here's the problem. If you name one of your children as a joint owner and you have 3 children and you put that child on just because it's convenient and they're geographically close to you, well, you could be accidentally disinheriting your other children because this property, this asset will only go to that child. That child doesn't have to give it to the other kids. So that's a problem. And if you put your name, if you add a child's name to your real estate, now you're exposing it to that child's creditors, that child's potential divorces. That's never good. And plus, you've lost control over it. If you try to sell it, you need that kid's permission, and half the money would go to that kid. Please, folks, set up a trust, fund your trust much better than just trying to do it shorthanded and just give away assets or adding names to accounts.
Todd Lutzke and the estate planning experts at Cushing & Dolan have written a brand new guide that details the estate planning blunders to avoid. You can request this brand new guide by calling 866-848-5699. That's 866 848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing and Dolan. Cushing and Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
See you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
This is the Money Matters Radio Network. WBNW 1120 AM and W275 CM FM. Concord, Boston. The Money Matters Radio Network. The U.S. Virgin Islands is the perfect destination for your next vacation. Visit St. Croix, St. Thomas, or St. John and experience incredible weather, iconic history, pristine beaches, world-class cuisine, and a vibrant nightlife. Book now and you might just make it in time for the St. Croix Mango Melee on July 7th. The family-friendly event offers food demonstrations and tastings, cultural dance performances, and the ever-popular mango eating contest. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, no passport required, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Are you retired like me and you just found out you owe the IRS a ton of money? Well, what would your life be like if they took your retirement savings away from you? They can do it and your property. If you owe the IRS back taxes or you haven't filed in a while, the Tax Relief Line is here to help you. They can stop the IRS from taking your retirement savings. If you qualify, you could have your tax bill reduced to zero. That's right. If you're retired and you owe the IRS a lot in back taxes, you could have your entire tax bill reduced to zero due. The IRS has now hired thousands of new employees, so they're ready to come after you. Don't let them take your retirement savings or property. Make this free call now.
800-251-2153. 800-251-2153. 800-251-2153. That's 800-251-2153.
Are you looking to volunteer for an amazing nonprofit organization that helps our veterans? The DAV Department of Massachusetts Transportation Network needs volunteers right now. This network provides free transportation to and from any VA medical appointment for veterans of all eras. To become a volunteer driver, you do not need to be a veteran or a DAV member. You just need to have the willingness to help our veterans and have a valid driver's license. Sign up now at davma.org. That's davma.org.
There are crucial mistakes you can make during the estate planning process that may have a damaging effect on your financial strategy. Cushing & Dolan's new guide is called Detour Ahead, Estate Planning Blunders to Avoid. Get yours today and make the right decisions to protect your assets. Call 866-848-5699. That's 866-848-5699 or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Leaving a Financial Legacy. Mike, one of the biggest assets that any family owns is typically the primary residence. How do you have to navigate how to leave that to the next generation?
Well, sure, and important because unlike, say, a bank account where you can leave a child as a beneficiary, that's not really possible with a home. And so, sometimes at least having just a basic estate plan, which according to a report from LawDepot.com. 73% of U.S. adults don't have a documented estate plan. But, that's the starting point here, is developing an estate plan for your assets after you go.
Other things that you got to keep in mind, I think, hey, if you have multiple children, is there one that wants to inherit that home? And how do you balance that with the other assets that you might have so that children are being treated fairly?
Yeah, there's all sorts of concerns here, right? As I age, what if I end up in a nursing home? How do I protect some of that stuff? And let me just tell you, it is an area that has a high propensity for mistakes when it comes to how to handle your personal real estate, especially later in life. So definitely something to be aware of. Keep an eye on understanding not only the tax consequences of one action or another, but also the legal consequences of one action or another.
The guide is titled Leaving a Financial Legacy, and there are two ways that you can request it. The first is by calling 800-393-4001. The second is by going to armstrongadvisory.com. Again, it's titled Leaving a Financial Legacy. You can request it at armstrongadvisory.com or by calling 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting DAV5K.Boston and making a donation today. The DAV 5K Boston is presented by Veterans Development Corporation. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Welcome back to the Financial Exchange. It is a Producer Price Index Tuesday. Tomorrow we'll be receiving data on consumer inflation via the Consumer Price Index. Anticipation there is for a 3.4% year-over-year read on inflation. That would be down from the 3.5% previous month, and a 0.4% month-over-month increase, but with core prices, stripping out food and energy, coming down slightly. So that will be released tomorrow morning at 8:30, very likely to drive markets in one direction or another. But quite honestly, from an impact standpoint, let's just go two different roads. One, it's hotter than expected and comes in at, let's call it 0.4% or above. Well, then that just kind of sticks to the Fed's current narrative, which is rates just need to be higher for longer, and we'll see how they play out. If it comes in lower than anticipated, then the Fed also will take a look at that and say, it's one data point, we can't make any policy shifts based on that, but if we get another one, maybe it will shift. So, not to say it's not important, definitely important to see where the trend in inflation is going, but unlikely to move the Fed's own expectations for interest rates one way or the other tomorrow morning. Stock market is open right now and been slightly positive since the open. Dow up 40 points or 0.1%. S&P up 7.5 points, 0.15%. And the NASDAQ leading the way up about 61 points, a third of 1%. Taking a look at the U.S. Treasury yield, 10-year sitting at 4.463%. That's a slight dip of 0.02% day compared to yesterday. And the price of a barrel of oil been trending a little bit further down. We're sitting at $78.20 per barrel. That's off about 1% this morning and off from a 2024 peak back in early April of about $87 per barrel. Anything else catching your eyes in markets today, Paul?
No, nothing that big. We'll see what 8:30 brings tomorrow.
As long as we are talking about oil, the price of a gallon of gasoline nationally is sitting at $3.61. taking a look, the New England states, Maine sitting at 361, New Hampshire 354, Vermont 363, Massachusetts 358, Connecticut 372, and Rhode Island $3.60 according to AAA. All of those prices compared to a month ago are slightly down. The month ago national average was sitting at $3.63. The one of the big news stories over the last 2 days, Paul, has been a resurgence of the meme stocks.
Yeah, I should say I didn't want to step on our story, but that is definitely catching my eye. GameStop
the
and
GameStop
AMC.
and AMC. Yeah, no doubt we need to address this. So before we do so, I think most listeners of our programs will have heard of meme stocks, but I do have to enunciate that properly because otherwise you might mishear it. So going back to 2020 and 2021, there was, well, a lot of excess cash out there and no gambling to be had because of all major sports being closed. And a lot of people poured into the stock market. And one of those individuals who developed his own following was somebody by the name of Keith Gill. At the time, went by Roaring Kitty, and developed a following on Reddit as well as other social media platforms. Before finally being outed as Keith Gill, who actually worked for Mass Mutual at the time, lives here in Massachusetts, as a matter of fact, and was responsible for a lot of popular investment that was not generally designed based on fundamentals of how companies were operating, but based on loosely on a few other principles, such as, hey, look at these big hedge funds and other institutional investors that are betting against a company. If we all band together and bump the stock price up, then these guys will have to cover their short positions, drive the stock up further, and by the way, we can put a bunch of Wall Street billionaires out of business, which they actually did in a couple cases. Kind of went silent after 2021. Lost his job at Mass Mutual, I think was barred from the industry by FINRA for basically a non-disclosed business activity, but made a boatload of money, and I don't think he really cares about the being barred from the financial services industry, quite honestly. For the first time in a few years on Sunday evening, he posted to X, formerly Twitter. Did not say anything, did not write anything about the stocks that he's looking at or some new strategy that he's come up with for investors to follow. What he instead posted was a picture of a gamer leaning forward in his chair, which, again, we're laughing because this seems ridiculous, and I'm sure everybody listening thinks it sounds ridiculous. It meant to insinuate that perhaps, or how people seem to have interpreted it, was that he's paying attention to the current situation and about to get involved in some way, shape, or form would be, I think, the insinuation that people are interpreting here. Based on that alone, what has happened recently with the stock prices of a couple major corporations, GameStop and AMC in particular, Paul?
We've seen GameStop today trading up 70%. That's on the heels of a 74% increase on Monday. GameStop had about 25% of its shares outstanding being shorted. So basically 25% of the flow for GameStop was being shorted. There was a heavy amount of short interest. Basically, a lot of institutional investors betting against GameStop. And as a result, from this one post that has been viewed over 23 million times on X from Keith Gill that occurred on Sunday night, the first, as you mentioned, in 3 years, we have seen, again, a la 2021, meteoric rises of GameStop over the last 2 days, and it just is, you just have to laugh at it, Mike. It's just absolutely incredible. He has united an army of retail investors to drive up a company that, to be clear, I was on speaking with a friend yesterday who said, is there something going on good with the company? No, absolutely not.
Nothing has changed.
The earnings report that they had,
still pretty ugly.
The earnings report that they had within the last week or so, in fact, was quite negative. They're making less money than they were a year ago. They're cutting headcount. There's all sorts of things that, from a fundamental perspective, the stock and the company looks to be in a very poor position. But here you go. We are in a similar boat to just 3 years ago, where we're seeing just a astronomical rise in the value of the company, and it's trickled over to AMC and others as well that were part of this phenomenon. BlackBerry and Koss, a headphones manufacturer.
So as you mentioned, AMC Entertainment Holdings up 63% on Friday. Their stock price was sitting at about $2.91, currently trading at $10 per share after these last 2 days of moves. AMC on the news, which they have done several times, by the way, announced that they will be selling 250 million shares of new stock, so effectively diluting shareholders, I believe, based on all this move, which, again, if you're executives at AMC,
why not?
Take the capital if investors are willing to buy your shares right now and go try and save your business. But I guess a few takeaways that I have from all of this. One, as it was back in 2021, this is gambling.
Mm-hmm.
Let's call a spade a spade. This is not what most people think of when they talk about investing. This is gambling. This is, spinning it on red, spinning it on black. I don't think there's anything fundamentally wrong with that. I don't think anybody's done anything illegal. I don't think that trading should be stopped in these positions. And I just think that, especially at this stage, people are pretty aware of the volatility of this situation and have seen what has happened. But anybody that's not familiar with it, just understand that that's what this is. It is not what most people would think of as investing. It is much more akin to gambling, and gambling has the large potential for massive losses, as anybody would know.
No, just take a look at GameStop's stock chart. I mean, the shares were as low as $9 just a month or so ago. So, you have to take that.
The second piece I will make about this, which is a bit tongue-in-cheek, but if we're looking at non-government data measures of financial conditions, and, we've mentioned a few of these before, kind of jokingly, right? Like, good Lord, people are paying how much to go to a Taylor Swift concert? And are you kidding me? Half of U.S. passport holders have plans to travel abroad over the next 12 months. I will add another one to the list. AMC Entertainment stock is tripling in 3 days. Financial conditions are loose. Inflation is still here. And the Fed is going to have to keep rates higher for longer. If we have this type of stuff happening in markets, and I know this is a microcosm, I know that any of this type of stuff can happen, but this to me is just one of many other indications that have nothing to do with CPI or PCE or PPI that would indicate to me that, this market is crazy right now, that inflation may be around here for longer than we anticipate, because this does not happen in a situation where financial conditions are extremely tight.
It happens probably with an accommodative Fed, which we talked about in the first hour of the show, that their posturing probably hasn't been tight enough or strong enough to, stop people from being as speculative. Not to say that they're following the Fed.
There's no direct connection here, right? Like Jerome Powell didn't allow AMC stock to raise by 3x or by GameStop stock to do so. But if we're talking about trying to interpret the cumulative financial information out there about the state of the economy, this is definitely not in favor of a tight Fed.
Right.
Definitely not.
I know it's a small sliver of trading activity, and it's so in the background to what's really going on a daily basis. These are stocks that are just not part of major indexes that we follow and things like that, but it still rings true.
It's also probably quite different from 2021 in that there are now a bunch of hedge funds and professional traders who follow Keith Gill and are probably participating in this trade and driving that stuff like in a different way than in 2021, right? In 2021, it was a bunch of retail investors jumping in and screwing over the hedge funds and going after them. I doubt there are that many hedge funds with giant short positions in GameStop still today. I bet there are a whole lot of them that are following exactly what this guy has to say and making a penny on it right now.
Or not say.
Let's take didn't actually say anything here. That's an important distinction as well. Quick break, and then when we come back, we're going to have some trivia for you next on the Financial Exchange.
Text us 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we're covering. This is the Financial Exchange Radio Network.
Are you looking to volunteer for an amazing nonprofit organization that helps our veterans? The DAV Department of Massachusetts Transportation Network needs volunteers right now. This network provides free transportation to and from any VA medical appointment for veterans of all eras. To become a volunteer driver, you do not need to be a veteran or a DAV member. You just need to have the willingness to help our veterans and have a valid driver's license. Sign up now at davma.org. That's davma.org.
There are crucial mistakes you can make during the estate planning process that may have a damaging effect on your financial strategy. Cushing & Dolan's new guide is called Detour Ahead, Estate Planning Blunders to Avoid. Get yours today and make the right decisions to protect your assets. Call 866-848-5699. That's 866-848-5699 or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
If you want to leave behind a financial legacy for your family, you need a proper estate plan. Hi, this is Chuck Zada from the Armstrong Advisory Group. In our new monthly guide, we'll explore how and why the estate planning process is crucial to help you build a plan that will afford you comfort and peace of mind as you enter your retirement years. The guide is called Leaving a Financial Legacy, and in it, we'll unpack ways to create a plan that takes into account your entire investment portfolio and your business holdings, including real estate. We'll also explore strategies on how to mitigate your risk from long-term care costs, which could affect you in the future. Call right now at 800-393-4001 to request a copy of our new guide, Leaving a Financial Legacy. That's 800-393-4001 or request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is the perfect destination for your next vacation. Visit St. Croix, St. Thomas, or St. John and experience incredible weather, iconic history, pristine beaches, world-class cuisine, and a vibrant nightlife. Book now and you might just make it in time for the St. Croix Mango Melee on July 7th. The family-friendly event offers food demonstrations and tastings, cultural dance performances, and the ever-popular mango eating contest. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, no passport required, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. Proper estate planning is crucial to you being able to enjoy your later years, and it may be the difference between retiring comfortably or living under incredible financial pressure. Creating an estate plan can be a difficult process if you aren't working with an expert who will make sure that your plan is secure. Cushing & Dolan can help. Call them today at 866-848-5699. Estate planning is their business, and they have a new guide out this month called Detour Ahead, Estate Planning Blunders to Avoid. Don't put your assets at risk and open yourself up to severe tax consequences. Even if you already have a plan, this guide may help you correct an issue that could come back to bite you in the years to come. Call right now, 866-848-5699, and get your free guide today. That's 866-848-5699. Or request it online from their website, legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Miss any of the show? The Financial Exchange Show podcast is available on Apple, Spotify, and iHeartRadio. Hit the subscribe button and leave us a 5-star review. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you in part by the U.S. Virgin Islands Department of Tourism. The U.S. Virgin Islands is the perfect destination for your next vacation. Enjoy St. Croix, St. Thomas, or St. John, and enjoy pristine beaches, world-class dining, and fall naturally in rhythm with the heartbeat of the islands. There's no passport required or money to exchange. Go to visitusvi.com and book your trip today. That's visitusvi.com. Let's do a little bit of trivia here on the Financial Exchange, and today is Rob Gronkowski's 35th birthday. Gronk was selected 42nd overall in the 2010 draft, played 9 seasons for the Patriots and 2 seasons with the Buccaneers, winning 4 Super Bowls along the way. Rob is one of 5 boys, all of whom have played professional sports. Trivia question today: how many of Rob Gronkowski's brothers played professional football? Once again, how many of Rob Gronkowski's brothers played professional football? Be the 5th person today to text us at 617-362-1385 with the correct answer. You can win a Financial Exchange Show t-shirt. That's 617-362-1385, and the 5th correct response will be our winner. See complete contest rules at financialexchangeshow.com.
Massachusetts Attorney General Andrea Joy Campbell taking Uber and Lyft to court yesterday based on allegations that they should be classifying their drivers as an employee rather than contractors here. It's a non-jury trial in Boston and comes amid this kind of broader push on Uber and Lyft that's taking form in many different ways. In Minneapolis, I know that they just started putting in a minimum wage for, or a minimum hourly rate for Uber and Lyft drivers, I believe it was. California had pushed to pass something on this front, but via ballot measure was shut down, and I think basically ensured that these companies are able to continue with contractor status on their drivers unless the legislature passes a law to that end. And at the same time that this lawsuit is going on, there are ballot measures that are trying to get onto the Massachusetts ballot this year that would, well, actually go in 2 different directions. There's one ballot measure that is looking to, allow an industry-backed ballot measure to go before voters that would define the drivers as contractors but entitle them to some new benefits. Then there's a competing ballot measure that doesn't address the same thing, but that would allow them to unionize those same drivers. So I have no idea how this is going to turn out. It is being ruled on by a single judge. No matter how it gets ruled on, it will almost certainly be appealed by both the state and the companies that are doing this. And so my guess is that nothing changes for the time being. I think there are reasonable arguments on either side to this as to whether or not they should be classified as employees, but the fact of the matter is that if they are, expect costs to go up.
Big time. This remains the biggest risk out there for Uber and Lyft. They dodged a bullet back in 2020 with that California Proposition 22, which was the idea that Mike was mentioning, where they tried to make it so that independent contractors of Uber and Lyft in California would become employees. It's 30% cheaper to have independent contractors. You can imagine what that would mean for Uber and Lyft if the 1.4 million drivers in California were required to be provided with sick time, unemployment benefits, on and on and on. It would just kill the costs on Uber and Lyft side of things. And as a result, as the end consumer, likely the gap between taxis and Uber and Lyft, and it's already narrowed significantly as there's been a bigger push for Uber and Lyft to become actually profitable after years of not being profitable, but that would almost become to a point of relatively even. And I think we've done exercises in the past before where the prices are relatively close, depending on what ride you look at out there and the timing of it.
A few items on this. One, every time something like this happens, Uber and Lyft threaten to pull out of the states. I very much doubt, even if they lost this lawsuit and appeal, that they would just say, yeah, we're not offering our products in the state of Massachusetts. I don't buy it. No. So, I'll just go there. 2 would be, I'm really kind of getting frustrated by a number of states that are trying to design laws that are company specific. And the federal government is doing so too. And I think that they're going to end up losing those on appeal. TikTok is the example on the federal government level where instead of saying, hey, we're creating a law that prohibits social media companies from being owned by foreign entities, they're saying we're banning TikTok specifically based on China. Likewise, in Massachusetts, if you're going to go after Uber Lyft, don't you have to go after hairdressers, and don't you have to go after every other contractor that works on a very similar type of basis as these folks do, whether it is cleaning staff at an office building or Uber drivers? There are dozens upon or package delivery drivers for Amazon are also in many cases classified as contractors, and I just have a really tough time drawing a distinction between why a driver for Uber should be classified as an employee, but a barber at a shop that rents a chair from somebody is not. So I don't know. I just wish that we would vote on this type of thing or have Congress pass a law that actually makes some sense here and clears up what the differentiator is, because I think there's reasonable arguments in either case, but that flexibility of time in my mind where you don't have to log on and drive for anybody does not make you an employee.
Yeah.
If you served in the Marine Corps, by now you know about the contaminated water problem at Camp Lejeune. If you were stationed or worked at Camp Lejeune from 1953 to 1987, you probably have a lot of questions. We have some answers. You could be entitled to compensation. Billions of dollars are being allocated to pay for damages to anyone stationed at Camp Lejeune during that time. Unfortunately, it appears that officials may have known the contaminated water problem existed and did little to protect their men. The Semper Fi code was not honored. If you or someone in your family has developed a serious illness, including various forms of cancer, call this Camp Lejeune legal support line right now. You can't turn back the clock and change what happened, but you can certainly call right now and learn your rights as a Marine. Here's the number.
800-477-1736. 800-477-1736. That's 800-477-1736. Paid for by Legal Alert Line. We are the Debt Destroyer Network. Any debt you have, credit card, tax, student loan debt, call now for free information that helps you destroy your debt. It's great advice. Plus, when you make this free call now, we have Debt Destroyer experts ready to help. They can show you how to destroy your debt and get your life back on track. Debt problems don't have to be overwhelming. You can live stress-free and debt-free. Credit cards, medical bills, IRS tax problems, even student loan debt. Learn about free programs offered by the credit card companies, hospitals, and even the government that can help slash your debt. Call the Debt Destroyer now for free information. Call now. 800-430-8804. 800-430-8804. 800-430-8804. Again, that's 800-430-8804.
The U.S. Virgin Islands is the perfect destination for your next vacation. Visit St. Croix, St. Thomas, or St. John and experience incredible weather, iconic history, pristine beaches, world-class cuisine, and a vibrant nightlife. Book now and you might just make it in time for the St. Croix Mango Melee on July 7th. The family-friendly event offers food demonstrations and tastings, cultural dance performances, and the ever-popular mango eating contest. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, no passport required, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Leaving a Financial Legacy. Mike, one of the areas where we see a ton of confusion these days is with retirement accounts and leaving them to the next generation. It's just a complicated place right now.
Yeah, and to start, some retirement accounts were actually looked at by some as a really successful planning tool for generational planning, especially when you talk about Roth IRAs, for example. And the rules around that all changed just a few years ago. And so really understanding the taxation of these different assets is important when it comes to leaving a legacy.
When we talk about what goes into those retirement accounts, this has to be part of the thought as well in terms of minimizing taxation during your lifetime and that next generation's. You have to coordinate what's inside of them just to minimize the taxes during that time as well.
Yeah, so from that perspective, you have non-taxable assets like a Roth IRA. You have taxable assets that generate a 1099 every year. You've got traditional IRAs and 401ks. All of these have very different rules in terms of how they're treated, but the biggest change had to do with retirement accounts, specifically 401ks and Roths, and the rules that impact beneficiaries of those assets. And so if you're trying to utilize them as a legacy plan, important that you understand the new rules.
Our guide is titled Leaving a Financial Legacy, and there are two ways you can request it. The first is by calling 800-393-4001. The second is by going to armstrongadvisory.com. That phone number again is 800-393-4001, or you can request it at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Missed one of our shows? Catch up anytime by asking your Alexa smart speaker to play The Financial Exchange. This is the Financial Exchange Radio Network.
Trivia question today was, how many of Rob Gronkowski's brothers played professional football? That'll be 3 of the 5 Gronk boys. Rob, Dan, Chris, and Glenn all spent time in the NFL. Rob's oldest brother, Gordy Jr., was drafted by the LA Dodgers and played professional baseball for 6 years. Doug in Medfield, Mass. is the winner of the Financial Exchange Show t-shirt, so congrats to Doug. And we play trivia every day here on the Financial Exchange. Tune in tomorrow for your chance to win. See complete contest rules at financialexchangeshow.com.
In June of 2021, the Surfside condo in Miami Beach area collapsed. 98 people died, and Florida passed a bunch of new laws in reaction to that collapse and a just absolutely devastating scenario. And this is the first piece that I've seen about some of the market reactions to those new laws. So effectively what we are seeing here, and I don't know enough about engineering to understand what sort of standards are being put into place, but buildings that reach the 30-year mark, specifically multifamily buildings in Florida that reach the 30-year mark, are now facing new inspection requirements. And a lot of those inspections are turning up presumably similar issues to what befell Surfside. And in Miami in particular, where they have a lot of these high-rise condo-type buildings, they have a much larger inventory of this type of thing than just about every other city out there. These older buildings make up a large portion of the inventory and are facing some very serious situations. So the Wall Street Journal did an interview with one individual named Ivan Rodriguez in 2019. He bought a 1,500 square foot unit with water views for $190,000 at a place called the Cricket Club in North Miami. The building was recently approved by the condo board to have a nearly $30 million special assessment for repairs, including roof replacement, facade waterproofing. It was going to be more than $134,000 per unit owner. Rodriguez didn't have the money to come up with it, put the thing on the market. Sold last month for $110,000, 42% less than what he paid for it in 2019.
Crazy.
So I know we're talking about housing prices being up some 50% across the country in a lot of markets right now. Florida is undergoing something quite different with a very specific subset of their housing market. In fact, where was this data that I found?
Units built less than 30 years ago are selling for more than 38% today than they did in 2020, but units that are 30 years or older are now going for 12% less than what they did back then.
And, this is not the case where every building over 30 years old is going to face these repair requirements. But I think what it's getting to is if you're looking at a building that's 28, 29 years old, you're saying, I'm not touching this thing with a 10-foot pole because I have no idea what the inspection's going to look like. And I'm sure that these condo owners are going to start doing things like saying, okay, we've done the inspection ahead of time to make people feel better about buying a unit, because otherwise I don't know how you possibly assess the risk of going into Florida and saying, hey, I'm going to go buy this unit for $250,000 right now, not knowing what the result of some big engineering audit's going to look like.
And not only do you have an issue with the buyers being hesitant, but any mortgage provider is equally, if not more, hesitant to provide a mortgage to someone who is looking to buy. So they make the point in this piece that you could have people that are qualified to buy these units, but unless they're an all-cash buyer, a mortgage backer is not looking to take that ride with them either. It's just a really difficult situation to be in. I can't imagine getting some of these assessment costs passed down after you're locked into your unit. It's horrifying.
$100,000.
Yeah. Right.
Or more. Entirely possible that it could be more than $100,000 for some of these repairs for some of these buildings. So wild stuff in terms of what's going on. We've talked about the Florida property market a fair bit, and this was definitely a different angle than I had been considering. It was definitely way out there in terms of, what's going on in the Florida market? Oh, yeah, there's this new law in place that's suddenly going to bump up multifamily inventory pretty rapidly.
I've heard feedback from clients, and one of you've heard it too, Mike, on roofs as well. There's a lot of scrutiny on people who have roofs in Florida that are over a certain amount of years to be replaced by their homeowner's insurance provider. So it's that whole insurance market and just the Florida property market, there are a lot of potential pitfalls that people can run into from a cost perspective.
Creating the right estate plan to help secure your future takes effort. There are plenty of mistakes that you can make, any one of which could have a dramatic and damaging effect on your financial strategy. Cushing and Dolan are experts in estate planning. Their brand new guide is called Detour Ahead: Estate Planning Blunders to Avoid. In it, you'll learn about these critical errors so that you can make the right decisions to always protect your assets. As an example, if you've created a trust more than 10 years ago and haven't updated it since, you're setting yourself up for some problems. Cushing and Dolan's new guide will help you address issues like this. So call right now, 866-848-5699, and ask for your copy of their free new guide called Detour Ahead: Estate Planning Blunders to Avoid. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing and Dolan. Cushing and Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
We've talked about this figure a couple times before, but I just want to mention it again. According to the St. Louis Federal Reserve, the total active listing count in the United States, which accounts for both single-family and condo/townhome listings for any given market, nationally, that number is up by 30.4%. across the nation. In Florida, that number is up 64% in April. Wow. You're scratching your head in New England, because in New England, I don't think there's a single state that's up more than like 20 or so odd percent. I think Maine was the highest the last time I looked, but states like Connecticut, Massachusetts, single-digit moves year over year in one direction or another. But you go to a place like Florida, you go to a place like Texas or Arizona, there is a large swath of inventory hitting the market right now, and I have a tough time believing housing prices stay where they are in some of those markets that have been, again, just crazy volatile over the last few years. So still more expensive probably than 2019 in the aggregate, but there are going to be situations here in some of these markets where people end up getting a bit hosed on these prices. Speaking of real estate and what's going on in that market, sky-high housing costs seem to be propelling the construction of now not so much the condos, but actual rental single-family homes. Last year, developers completed 39% more rental home projects compared to 2022. I don't really know how this works in terms of planned development, right? Because I think as a developer, you go and build a single family home, you can probably choose whether or not you want to build it as a rental or a sale. And you're probably just adjusting to the state of the market at any given point in time, saying, oh, is it better to rent this home or to sell it? But clearly some demand from even traditional buyers out there who just don't see the value in buying a home right now.
Yeah, with mortgage rates sitting at 7%, it seems as if property developers are leaning more on the rental side of things. We've talked about the inventory issue. Now, granted, it's up from where it was in 2023 in terms of single-family homes, but from an affordability standpoint, where it sits today, you can drive more demand, it seems like, on the rental side of things. Obviously, with rentals, there becomes a lot more legwork that's a part of that process in order to maintain property management, but developers seeing an opportunity there to take advantage of people who are looking for inventory that perhaps can't get over the 7% mortgage and 20% down payment.
Yeah, no doubt. Looking at the state of housing market, I feel like when I spout out a bunch of numbers, it can get a little bit confusing. So I apologize, but this is important context. In April of 2019, total U.S. inventory, according to the St. Louis Federal Reserve, sat at 1.137 million properties for sale. As I mentioned, that includes single and multifamily condos, townhouses, etc. The lowest April month that we got came in April of 2022, when that number was down to just 380,000 homes. Tiny levels of inventory. I mentioned we have now crept back up, where year over year this number is still way up, but we are now, April of 2024, sitting at 734,000 homes. That's a big increase from 2022 and explains a lot of what we're seeing out there. But compared to April of 2019, when we had, again, 1.14 million homes for sale, we're still looking at a 30 to 40% drop off in inventory compared to those levels. And so each state is different. Each part of the country is a little different on this, and it varies dramatically from state to state, city to city even. But the story shows continued improvement, but still a very weak inventory situation across the nation when we look at housing, which can be ultimately a big driver of economic activity. Let's take a quick break. When we come back, bit of stack roulette for you next on the Financial Exchange.
The Financial Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network.
A recent report from LawDepot.com says that only 3 out of every 10 adults in the U.S. have taken the time to create an estate plan. Don't be a member of that group. Hi, this is Mike Armstrong from the Armstrong Advisory Group. A sound estate plan can give you control over your assets and peace of mind as you enter your retirement years. Our new guide is called Leaving a Financial Legacy, and in it, we look at estate planning from a financial perspective. It's important to have a strategy that addresses your investment portfolio and all of your holdings, including real estate. We'll also focus on other issues, such as how to manage long-term care expenses that may affect you down the road. Get your guide today by calling 800-393-4001. That number again is 800-393-4001, or you can also request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is the perfect destination for your next vacation. Visit St. Croix, St. Thomas, or St. John and experience incredible weather, iconic history, pristine beaches, world-class cuisine, and a vibrant nightlife. Book now and you might just make it in time for the St. Croix Mango Melee on July 7th. The family-friendly event offers food demonstrations and tastings, cultural dance performances, and the ever-popular mango eating contest. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, no passport required, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Are you looking to volunteer for an amazing nonprofit organization that helps our veterans? The DAV Department of Massachusetts Transportation Network needs volunteers right now. This network provides free transportation to and from any VA medical appointment for veterans of all eras. To become a volunteer driver, you do not need to be a veteran or a DAV member. You just need to have the willingness to help our veterans and have a valid driver's license. Sign up now at davma.org. That's davma.org.
There are crucial mistakes you can make during the estate planning process that may have a damaging effect on your financial strategy. Cushing & Dolan's new guide is called Detour Ahead, Estate Planning Blunders to Avoid. Get yours today and make the right decisions to protect your assets. Call 866-848-5699. That's 866-848-5699 or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
For 40 years, Cancer Support Community has been a relentless ally for anyone impacted by cancer, with free services provided online and in person, with their newest location in Massachusetts. Connect with Cancer Support Community Massachusetts for free emotional support, educational resources, patient navigation, financial counseling, and more. 617-797-3391. CancerSupportMass.org. CancerSupportMass.org.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Breaking business news as it happens, only here on the Financial Exchange Radio Network.
Time for a bit of stack roulette. Paul, what do you have for us to kick things off?
What's on TV for many Americans? Now it's YouTube. A recent study done by Nielsen indicated that people spent nearly 10% of their TV viewing time watching videos by creators like Mr. Beast on YouTube. And I found it an interesting piece, Mike, because my two kids, both under the ages of 3, have never watched any type of traditional TV their whole lives. In the very short lifespan, we have only put on YouTube. Miss Rachel and Blippi are the two main creators that they consume, and they have never seen the traditional commercial setup of a regular cable broadcast, and I feel like a lot of younger generations fall in that bucket as well.
But you would include Disney Plus in this new category?
They're not on Disney Plus yet, but okay. they would.
So primarily YouTube?
All YouTube. Every single time I'm turning on my TV for the kids, it's YouTube for those two.
Do you pay for it?
No, it's just attached. So we have the ads. So we see the garbage ads, but it's part of a smart TV, and that's all that we utilize. And I feel as if that's more and more the trend for younger people out there.
I'll tell you. So my kids are 7, 7, and 5 years old.
So the next kind of step up.
The very same can be said. Like, if we're sitting down as a family, I won't watch that garbage. Mm-hmm. But and not that it's harmful in any way. Like, I don't think the content that I'm seeing them watch on YouTube is any worse than what I'm seeing on Disney, Nickelodeon, or any other platform. Right now, they seem to be really into this creator, the Ninja Kids, which is basically a bunch of, like, 8 to 14-year-olds hanging out. It seems like them just hanging out at, like, ninja type gyms and doing sorts of competitions, and like, okay, you're kind of weird that you're watching kids do non-sports athletic competitions, but they apparently make it entertaining enough that that's what they want to watch, and I'm assuming see themselves in some of these kids and watch it for those reasons. And I'm just constantly on the lookout, like, is this something that I want my kids consuming? But like I said, I'm just not sure that it's any more harmful than the stuff that I would traditionally prefer, like a Disney show or like any of these other things. Again, if we're sitting down as a family to watch something, it's not going to be YouTube. I don't consume any YouTube created stuff, but Yeah, they're clearly cleaning up on that advertising dollar.
If you think about the stuff that we were watching growing up, the cartoons and stuff, the difference between, Ninja Gym experience videos versus, Ren and Stimpy or whatever one
Ren
you
and
want to
Stimpy
throw,
came to mind. It's just particularly disturbing.
Yeah, whatever you want to throw out there, Rugrats or, SpongeBob, all those things, it's not as if one was, prohibitively better for us than what the kids are consuming today. But it's just interesting.
Now, the real argument would be how much time is being spent in front of those screens in general.
That's the thing to me,
part that
as a parent,
increases.
that you focus on the most, right, is trying to limit screen time. And that's no different than, granted, our screens were the old school box TV screens, but the same thing applies for any type of distraction like that. You just want to limit the amount of time on it as best as possible. But I do find it interesting that you and I think I've spoke about it before, that our kids will likely never know the channel numbers that they would go to on a basic cable package that we've come to absorb and memorize over time.
Speaking of those basic cable packages, Comcast later this month will be launching a 3-way bundle. So get ready with Peacock, NBC's streaming platform, Netflix, and Apple TV Plus, all offered at a deep discount, according to Chief Brian Roberts. I agree. That is a platform that I would imagine there's a lot of crossover on with subscriptions, but streaming's dead. Streaming in the way that we thought of it previously is dead. We're just getting back to bundled cable packages, and no doubt Comcast is going to get a deal on this, but the way they're going to do it is the same way they've made money in the past, which is, you want this bundle? Great, you're signed up for 2 years. Here are all the add-ons and extra fees that we're going to charge you for each of these set-top boxes that you don't need, by the way, if you're streaming Apple TV Plus and Netflix and Peacock. Those are completely unnecessary in those cases, but looking at this, I don't subscribe to Peacock. I don't subscribe to Netflix, but I do subscribe to Apple TV Plus.
No Netflix.
No Netflix, yeah.
Wow.
I've had it at different times, but we kind of rotate them through, and I do not have Netflix right now.
I was going to say, of the streaming experience in general, they seem to be the one company that's differentiated themselves a bit and continued to show pretty strong subscriber growth. Some of these others, like Peacock, I just don't know if there's enough ammo in terms of content library to make it sustainable, but I did think that Netflix continues to do strategically a pretty good job, whether it's the live sports foray that probably will come at some point that's been rumored about, the comedy special that drew a lot of attention with the roast of Tom Brady, but it's done well.
The only reason I have Max subscription right now, HBO, is because they carry Bruins games in the absence of TNT, which I don't get on my stupid
You can cancel
football.
that one after tonight. No Marchand again.
Yeah, not exactly.
Cancel Max tomorrow. Note to self.
Excited about the prospects there, but yeah. Piece from Bloomberg: treat buy now, pay later loans like real debt. I have to agree with this one, but I also think it is very unlikely to happen. If you are unfamiliar with what I'm talking about here, Klarna, Affirm, many other peers out there, there are these buy now, pay later services where effectively buy the product, get it immediately, and make whatever it is, 10 payments over 10 months or 6 payments, and effectively it is debt of a different sort that is different from credit card debt, but because of the rules that are out there, is not required to be reported to major credit bureaus, and quite honestly, if you're Klarna and Affirm, you don't want it to be.
No, of course not. That would just limit your customer base dramatically if those regulations were enforced on them.
So credit card issuers, mortgage issuers should want to know about this stuff. The reason, by the way, that Klarna and Affirm don't want this stuff reported is it's pretty technical, actually. It has to do with the way that credit bureaus rate you and give you a credit score. And one of the things that hurts you is if you have more lines of credit outstanding. So let's say Paul buys 3 products from Amazon, all on Affirm. Might be less than we would put on a credit card, but will hurt him more than having put those items on a credit card. And
right.
So I do think that stuff needs to be worked out, but in the meantime, there's a lot of lenders out there that are operating at least partially in the dark, and that's definitely a problem. Quick break. We'll be back in 22 hours, so not that quick. CPI out tomorrow. Expect some market moves on reaction to that 8:30 a.m. report. We'll be back at it then. Have a great day, everybody.